Let's just kick it off. Don't want to keep people waiting for people on time, and I'm sure people will roll in as we get started. I just wanted to introduce myself and kind of tell you a little bit more about this, and then Kevin will dive into all the good stuff and educational stuff that we're going. So this is a webinar series of about real estate tax strategies. And I wanted to start this because Kevin and we were at lunch and we were just talking about real estate tax strategies. He was giving me some information and just wanted to share it with all of you and anyone else that is investing in real estate and to find ways to save money on your taxes. I know that what I read, the wealthy, that they do it the best, and that's how they keep their money. And it's a way. Just want to share it all with you. This is the second session. We're going to be diving in about depreciation. The first one, I do have the recording, so just I'll send that out, or I already did, but I can send it out if you don't have it. And then we'll record. We're recording this one, so I'll send it out, everyone, to you guys as well. Well, our next one is going to be about short-term rentals. That's going to be next Monday, same time, 6 p.m. Mountain Time. And yeah, that one will be really good as well. Kevin will be again, sharing his knowledge. I just want to again thank Kevin for taking the time out of his day, his busy schedule, to share his knowledge and what he does. And he's an investor himself, so he knows what he's doing, and he uses these strategies with every other real estate investors as well. So thanks, Kevin, and why don't you get started, and I'll stop talking.
Thanks for the intro. So I love teaching people the taxes, but especially the nuances in real estate tax world. It's far more complex than most people think, to be honest. Um, I'll share my screen here. Let's see. Screen two. Share. Are you all able to see that? Yeah. All right, cool. So yeah, as Eric said, today we're going to get into the art of depreciation, really, and accelerating depreciation. I'll probably say multiple times, but this is the big hitter. This is what everyone looks for in the tax world when it comes to real estate. I kind of think of when you're looking at real estate, there's usually two pictures that I like to think about. One is the real world. You want a property that cash flows. Your bank account should reflect that. It should be a good investment. On the other hand, for taxes, that's a whole different world. And you want losses there to offset one, either other rental properties that have income, or two, maybe even your W-2 income, or if you're an entrepreneur, your business income. And a large part of how people do that is depreciation. So, yeah, like Eric said, my name's Kevin Bevillard of Intentional Living CPA. So I'll just go over who am I? I've done this before. This is on my private presentation, so I won't go through all this stuff, but I think the highlighting aspects are I'm a CPA. I've been one for about 10 years now, specializing in real estate and business taxation. Um, thing that kind of makes me unique is I'm also in the real estate space. My wife and I, we've started back in 2020. We've done almost solely full remodels in and out of state, midterm, short term, long term. So I can talk taxes with this stuff all day. I can also talk strategy in terms with are you looking to buy another property? What was the lender going to look at, not look at? You know, if you want to even go into what kind of tile you're going to use on your shower remodel, I can have a conversation with you about that. Um, so yeah, just a little bit about me. Who aren't I? I'll reiterate this every presentation. I am not a lawyer, hence I'm not your lawyer. I'm also not a CFP or CFA, so I do not give financial advice. And all information on this presentation is for educational purposes only. Um, so do not go prepare a tax return yourself and say this is what Kevin said. So, and everything I say, just to give you an insight into the tax world, there's about 75,000 pages from tax code to regulation, revenue rulings, that kind of stuff that we rely on to do a single tax return. So it is extremely complex. And one small change in your fact pattern could totally twist an entire situation. So all this again is educational, and I can get as granular as we need to, but in the end, everyone's situation is nuanced. This presentation isn't going to be extremely lengthy in slides. So since we don't have like a million people on this call, feel free to unmute yourself after each slide and we can discuss, topics on it. Anything I say may be a unique situation you're dealing with. We can definitely just riddle through some Q&A as we go through each page here. So topics for the day: what is depreciation, bonus depreciation, cost segregation analysis, stacking strategies. This kind of feeds into the next presentation, and timing considerations. So overview of what today is. Again, it's all about depreciation. That's what we're focusing on. So obviously, to start off the call, what is depreciation? At the top here, the IRS defines depreciation as an annual income tax deduction that allows you to recover the cost or other basis of certain property over the time you use the property. It is an allowance for the wear and tear, deterioration, or obsolescence of the property. That's straight from the tax code. Um, it is, think of it again, it's essentially wear and tear in your building that the IRS is saying, you may not have to replace the baseboards of your home every year, but people are going to kick the crap out of it. And eventually, in 10 or 20 years, those baseboards are going to have to be replaced. And so they basically said, you spent, let's call it $5,000 on baseboards throughout the house. You get to depreciate that over a certain number of years that they prescribe. That is depreciation. It's a tax deduction that you won't always see on your cash flow statements when it comes to rentals. So again, you have two worlds here. The real world, you're trying to cash flow. The tax world, you're trying to get a loss. How you get a loss in the tax world that makes that loss, or that takes that profit from the real world and makes it a loss in the tax world, is depreciation. That is one of the big key aspects here. The IRS assigns a pre-prescribed lies to all assets, and you follow the rules for depreciating those assets over the length of time allowed. Um, there is a publication, it's publication 946. The thing's like 100 pages long, and it just goes over high level depreciation. So like, if you have this generic asset, you should depreciate it this way or that way. So it's extremely nuanced, and the fact pattern matters greatly. What did you spend money on? Is it affixed to the building or not? When did you finish it? So all those things do matter. Any questions, or does anyone not really understand what depreciation is after that brief overview? Because we're gonna build off that a lot in this presentation. Cool.
I have a quick question, Kevin, actually.
Yep.
Do you know what obsolescence means of the property? Like, is that just
Um,
it gets old, so it can't rent it out anymore or something? Or
yeah, that's for properties that doesn't really come into
commercial?
play. It's more so like, think like a Mac computer from
Got
1995.
it. Got it.
Yeah.
Okay.
The real estate's really hard to be obsolete because we have structures standing up for hundreds of years. Good question though. And again, this code section applies not only to the building, right, of your rental property, but if you're running a business, it could apply to hardware, it could apply to your vehicle, it could apply to, a tractor business if you're doing demolition or something like that, and you have a bunch of large pieces of equipment. So depreciation is spans across businesses and real estate.
So sorry, Kevin. That just
Yeah.
got me to another question. With the businesses, if you have a short-term rental, is the furniture, is that something you can include, or is that just going to be like an expense?
Furniture could. Furniture is one of those things that if someone tells me they have a short-term rental and they furnished it, I will tell them, okay, we need a breakdown of, what you spent money on because there's some exception statements you can attach to your return where you don't even have to go through this process of depreciating a mattress for $1,000. You don't there The IRS understands that depreciation is it's a burdensome aspect because we have to track it every year until you sell that property, essentially.
Yeah,
So there's some de minimis exceptions. There's some exceptions altogether to get around depreciation. So there's ways around it, and one of those exceptions is it's Regulation 1.263A1F, and it's a statement you attach to your tax return. And if you buy a piece of tangible personal property, first off, what the heck does that mean? It's just something you can move around. Okay, it's not like an HVAC system. It's not ductwork. It's not a new roof. It's like a bed frame, a mattress. As long as you spend under $2,500 on one of those items, you don't even have to worry about depreciation if it's a tangible personal property. You can just expense it. You get 100% of that deduction year one. You attach this statement to your return saying, hey, I'm doing this. Boom, you're good to go.
got it.
Maybe
Makes
just
sense.
quickly question. So it makes sense to, if you buy a mattress, to stay with that example, to buy a mattress below 2,500. As yeah, did I
Exactly.
get that right?
Correct. Yep. You
Okay.
want to
Then
stay and like people
insert.
some CPAs, some people get this confused, but let's say you buy a mattress, Alex. Let's say you buy three mattresses from a guy and you pay him 4 grand for three mattresses. As long as you can prove out line by line each mattress was under $2,500, you should be fine. So it's not
Okay.
by invoice or, you know, bank
Itemized.
transfer. It's itemized by line item. Correct.
I guess we will get there when we talk about cost segregation, but land, as an example, is not a tangible asset in that sense, what you just explained, right?
Yeah. So everything we're talking, land is always excluded. It's not depreciable.
Right.
You should
Which
put it
makes
on your,
sense because it doesn't really depreciate anyways, right?
yep.
Long term.
It was here long before us. Once everything's wiped off the planet, it'll still be here probably.
Yeah,
So,
but you mentioned the
um,
roof. That is definitely depreciating, right? So now the
the what?
question is, can we have the roof?
Yeah. Yeah. Structural components you want to or you don't want to, you have to depreciate. So, and depreciation isn't a voluntary thing. You can't be like, oh, I'm not depreciating it. The IRS is like, you have to depreciate that. And I've seen people that think it's voluntary when they go to sell that property. It doesn't matter. When you calculate the gain or loss on that piece of property, whether they took depreciation or not, you have to do that computation as if they took depreciation. So they received no benefit from depreciation in prior years, and they're going to have a much larger gain when they sell that property. So they're getting kind of screwed, twice. I've seen that a few times where people try and get a little bit uh, too tax savvy for themselves.
Thank you.
Bonus, yeah, bonus depreciation. So in the last presentation, and I'll just kind of go over depreciation from from the IRS's perspective and kind of how I look at it is you have like three tranches. For real estate, it's really two tranches of depreciation. The first one is called IRC 179. You don't see that. It is bonus depreciation in a sense, but it has different limitations on it. IRC 179 is generally the first thing you look at. The reason you don't see 179 depreciation done on real estate is because in rental real estate, we are wanting to create a loss. IRC 179 accelerated depreciation cannot increase or create a loss for rental real estate. So generally speaking, I don't even consider that most of the time, especially how the codes are written today. So it's uncommon to see that in rental real estate. The next one is bonus depreciation. So, right, we're going to look at 179, not going to use it most times because we want to generate a loss. So, we're going to skip that and go to bonus depreciation. Bonus depreciation is like the great write off. When you can have bonus depreciation and pair it with a nice side of a cost seg study and the STR short term rental loophole as the dessert, those three things come together to create this massive advantage in the tax world to generate a loss, which you hopefully can then offset your W 2 income with, which then creates a much larger refund when you file your tax return. And right here, bonus depreciation, it's code section 168K. Everyone calls it bonus depreciation because it's just an accelerated form. If the IRS says, hey, you have an asset, you have to depreciate that asset over 5 years, you can take bonus depreciation and say, no, I'm not going to do that. I'm going to depreciate it, but I'm going to use bonus depreciation. And for 2025, you get to take 100% of that cost basis as an immediate deduction. So does anyone have any questions about that in terms of what bonus depreciation is, high level?
I will have some
I'm
questions how to make sure you get it. Maybe I'm ahead of myself here, but I heard like you have to spend 100 hours on the short-term rental property on your own. You're not allowed to stay more than a certain amount of days. Will you talk about those things later?
Yeah. In next week, we'll dive into the short term, how to qualify for that.
Got it.
Yep.
I just was gonna ask. I've heard lately from multiple folks that this was due to like the big beautiful bill. Is that true? Like, is that where this 100% is coming from? Just curious.
A piece of that bonus depreciation originated in 2001, after 9/11. So it was George Bush implemented this to accelerate the economy to pay for the war in the Middle East, essentially. And it was, how do we get taxpayers to spend money? Okay, if we give them a huge tax break, if we give Bob a massive tax break, if he goes spends $100,000 on a giant piece of construction equipment, he's more incentivized to do that. So the origination started in 2001, and every year it's different, or every year you have to look at what the IRS allows as bonus depreciation, because you can see right here there's different percentages, and you're right. So bonus depreciation originated in 2001, it's adjusted annually. July 4th, the OBBBA passed, and they made bonus depreciation permanent. I'm using air quotes here because nothing is permanent in the tax code. That's just semantics to make it look nicer than it is. They could take it away tomorrow if they wanted to.
Mhm.
If they didn't pass that bill, this number right here would have been 40%. And then this number would have been 20%. So you can see a decrease of 100 to 80 to 60. If the bill didn't pass, it would have been 40/20, but it passed and it revived 100% bonus depreciation. The one nuance there is the asset has to be purchased and placed into service in 2025 to qualify for that 100% bonus. So purchased and placed into service.
So with the remaining days we have left in this year, is one single booking on Airbnb enough to qualify to put it in service?
Yeah, that's a great question. Well, I'll touch on that in the cost set or later on and on STR. But yeah, generally speaking, the technical terminology in the code is it has to be ready and available for use. So if it is ready to go and it's sitting there empty, technically you can still do it. I tell taxpayers at least get one or two third party stays in there, because if the IRS sees a massive bonus depreciation deduction and no rental income up top, like none, um, that's kind of like a yellow orange flag to see like, hey, what's going on here? But again, if you can substantiate it by being like, hey, look, the renovations were done. It was listed on Airbnb December 2nd. No one booked it. I can't do anything about that. It was ready and available for use. You're generally fine.
Okay.
Um, but yeah, bonus depreciation is an IRS prescribed and automatic. You can elect out of bonus depreciation, but if you do not elect out and you do not take it, you kind of get screwed. Unless you want to go back and amend your return. And there is some reasons more so in business world where you want to elect out of it, but it's an automatic election in the current year on certain assets. Again, this is an accelerated form of depreciation, so it's in lieu of spreading the deduction over 5 years, let's call it. The assets must be tangible personal property with a useful life of 20 years or less to qualify. That's key because this is why we do the cost segregations to get bonus depreciation. A house, a residential house, is generally depreciated over 27 and a half years, which is over this 20-year mark that the IRS says you have to be at or under. So to get a piece of your purchase price to be under that 20-year threshold, you have to do essentially a cost segregation study to break out the basis in the building into different buckets instead of just putting it all into the building. That's why a cost seg is so valuable to get done if you want to generate large losses on an STR, or if you qualify for real estate professional status. This last bullet here, it's a one and done. It's a one hit wonder. So you cannot do it year over year on the same asset. You do it once when the asset's placed into service. You do not get future benefits. So it is a tax deferral method. It's not permanent tax savings generally. It is tax deferral. You're taking a juiced up loss in year one. Generally over time, if nothing else changes, you're going to have less and less of a loss in later years because you accelerated this depreciation.
Kevin, one clarifying question. So you said it has to be I forget the word you used, but basically in service. I think that's what
Yeah,
do you
ready and
have to,
available.
yeah, does it have to be like if I bought it today and we close today and I put it in service in 2026, then I can only use the 2026. I can still do it.
Yeah, yeah.
Okay.
You're gonna have to if it's let's say you buy a house today and you have to get the floors ripped up and redone and you don't list on Airbnb until January 7th of 2026, you can't you don't put it on your 25 tax return, you put it on your
Okay.
26 tax return.
Okay. Just want to make sure it didn't have to be purchased and placed into service in the same year.
No, no. For this, except with the bonus depreciation, I think it's like whatever the inauguration date was, January 14th or 19th or something. So it has to be purchased and placed in service on or after whatever that date is, January 14th or 19th, I forget. But like I had a conversation with a client the other day. They purchased it like December 29th or something, 2024, went into service February 2nd. Um, I just told them straight up, I was like, hey, this is option one. This is option two. If you are more, here's the technical language. Here's the repercussions if you say, hey, let's say it's purchased and placed into service. Let's take the higher depreciation. And I understand the risks. I'm still kind of waiting for guidance on this because in the 24 years bonus depreciation has been around, it has never been. I don't know if they messed up the language on this thing, but it didn't matter when you bought it. It only mattered when it went into service. So I don't even know how they're going to track this because on the depreciation reports, it doesn't show when you bought it. It just shows the date in service and that's it. Um, and it kind of like if you think about it, someone buys a house in 2020 and they move out and use it as a rental, like who could have seen this code section coming down the pipeline? So like I'm a little like I play a little bit with wiggle room here and letting the taxpayer decide. how aggressive they want to be. And I'm still kind of like, this is kind of a bunch of BS that they worded it this way. I don't know if it was on purpose or not, probably was, but um, yeah, I don't even know how they're going to enforce it or if they're going to change all the the depreciation schedules. So
I have a quick question on that.
yeah.
When it comes to price, is there a limit on, or more so cost over price? But the cost of the actual asset, say, like you said, you get your floors done versus, an appliance, there's going to be a big cost difference between that. So where's your limitations on that? And yeah,
Yeah, so in that example, if you buy a refrigerator and it's $1,000, you can just expense it under, what I said earlier with being able to take an exception. But let's say you buy a refrigerator for 3 grand and you have, let's say, tile install. And again, this is where it comes into the nuances of different floorings depreciated differently or can be. So like with tile, it would probably be 27 and a half year life. So you would actually place it into service. Let's say you get the tile work done for your kitchen January 15th, you would actually have to depreciate that over 27 and a half years and you get no bonus. But if you're sticking in like really temporary type flooring that you'll probably gonna like carpet, that could qualify for bonus depreciation because I would probably say let's depreciate over 5 or 10 years. So that's where like the
That's
nuances really come into play with cost segs and getting details to your CPA on what was done.
sounds like it's less of the cost than it's the
Yeah, yeah.
price.
Sorry. To answer that question, cost if it's over $2,500 or if it's struck or if it's under 2,500 and it's structural to the building, doesn't matter. Yeah, amount doesn't matter.
gotcha. Cool, thank you.
Aisha, you raised your hand. Did you have a question?
Yes, it's kind of like a very specific scenario, so I'm not sure. I'm trying to think about how to even phrase it. But so I bought a home at the end of last year, December 2024, but it was as a primary. So, we had to be in it, etc. But it's the year, like that first year that you have to be in it is coming up and it's going to be immediately a rental. So would it make sense to like, would I be eligible to put it in as depreciation for next year if I have it rented right away within December?
So you bought it in December of 24. Is that right?
Right. But it was a primary. It wasn't originally like as a rental, but now it's
Okay.
going to be.
And then you're going to place it into service as a rental in December of 25.
Right.
Okay. Yeah, I mean, you're kind of in that. Yes, one, you have to depreciate it regardless. Two, you could do a cost segregation study to get that bonus depreciation as long as it's ready and available for use in 2025. You're in that same situation as the other taxpayer I was describing, where per the new bill, the OB, the what one big beautiful bill that passed in July, the verbiage is the property has to be purchased and placed in service after January 14th, let's call it. Since you bought it in December, January 14th, 2025, since you bought it in December of 24, it's really up to you if you want to do that cost seg. You still get bonus depreciation regardless. It's just technically in your situation, you would fall under the old bonus rules, which would be 40% bonus instead of 100% bonus. But again, if you have a decent CPA, like understanding the background and the history of the bonus depreciation and what it's meant to do and how they track it, you could be more aggressive or less aggressive. It just is really up to you whether you take the 100% bonus or 40% bonus after doing if you do a cost seg.
Okay. Thanks.
Yeah.
Just because you mentioned the cost segregation study, do you necessarily need to do the study? Do you need to hire someone who's creating the study for you? Is it basically just dividing the housing, the structure, the furniture from the land, or what's like the purpose of the study, and how do we get the study?
Yeah, so there's like multiple ways to get it done. But it's what you just described, right? And I'll run through an example here shortly after this slide, kind of breaking it down for you. But it's you buy a house for $1 million. You're going to take away the portion you assign the land. So throw that out of the way. We're stuck with $800,000. If you don't do a cost segregation study, generally you're going to depreciate $800,000 over 27 and a half years, straight line.
Mhm.
Since we're over that 20-year mark, right, for bonus depreciation, you get no bonus. To get bonus, you do the cost segregation study because the cost segregation just breaks that $800,000 down into separate pieces, right? Um, and I'll kind of talk about that in a second too, but that's essentially how it works.
Just wondering how my former CPA did it for me because I did the 100% deduction already with one of my condos, and they didn't ask me for a cost segregation study. So I'm wondering what value they put in, but it kind of worked. So I'm wondering if I made a mistake here without a study.
Um, yeah, I mean, I could, if you want to like email me offline, I could take a look at it and tell you. Um,
I will come back on that. Okay, good to know.
okay. Yeah, cost segregation study just kind of went over what it is. This is essentially a claim bonus depreciation in a tax year with a rental property. Rental property without a cost segregation, you have to depreciate. And again, this is nuanced too, but generally you depreciate a residential structure over 27 and a half years. A residential rental property with a cost segregation study, you get to depreciate over 5, 15, and 27 and a half years, generally speaking. So you see, we're breaking it out into shorter lives, essentially what it does. The type of cost segregation study you get done could depend on the overall price of the property. If like we're talking low cost properties in Georgia, just because that's where I'm from, and you're spending $250,000 on rentals there, you can get, I recommend doing a questionnaire analysis cost seg. If we're talking about properties in Colorado that are $600,000, $700,000 purchase price, I would recommend an on-site visit study. And um, that's where someone actually goes to the property, they do an analysis, they bring in an engineer or they're an engineer themselves, they break down all the components, they create a report saying, hey, this is the structure. Here's a bajillion pictures. Here's what the HVAC system, the water heater is. Here's all the duct work. Here's how many outlets they have. Here's the square footage. It's a complete deconstruction of the building as if we started from dirt and built it from the ground up. And the engineer assigns lives to all those different components. Um, I highly recommend doing a cost segregation the first year the property is placed into service. That is generally the correct way to do it. You
Mm.
can go ahead, Alex.
No, so I was wondering, so with the remaining time for this year, even if you would close in December, put it into service, but then the study isn't done this year, you might run into trouble if you do it.
No, you just have to get the study done before you file your tax return. So technically, you would have until
Okay, so
October
because you
15th.
don't file before April, so you basically have time until April next year.
Yep, exactly.
Got it. Makes sense.
Yeah.
And put it into service first, but that's critical, right?
Yeah, hitting all the metrics to place it into service in a tax year. And then, of course, like whether you qualify for the short-term rental loophole, whether you qualify as a real estate professional, or if you have other criteria to hit where you're wanting to offset your W-2 income, right? You want to hit those hurdles first and then finding someone to do a cost seg, paying for it, getting it done. It just has to be done before you file your tax return.
Got it. Thanks.
I have a question on how much does it usually cost to do the cost seg study? If you already covered.
Yeah, it really depends. I mean, for the questionnaire analysis studies, I can do them for my clients for around $1,600. If you're doing an on-site visit, and again, I only recommend those if it's lower price properties for the most part, or if you're just cash strapped. Um, for higher price properties, on-site visits are recommended, and those can range anywhere from 3 grand to $100,000, right? Technically speaking, like you can own an apartment complex, and that cost seg study is going to be very, very expensive. So it really depends. And I mean, I don't recommend this ever, but if you think you're very tax savvy, you could probably find an online questionnaire analysis group that will give you access to their software for $600, $700. to do it. But then again, wouldn't recommend that because there's a lot more analysis involved than what you think. So, but I have seen it before.
Got it. Okay, so even if we keep track of all the line items in the budget, what was spent, everything, it's not recommended to do it ourselves.
No, because a cost seg study is generally speaking the day you buy a property. Let's say you buy a rental March 12th. You generally run the cost seg study and it's a rental property. Someone's already living it, blah, blah, blah. You generally run the study as of March 12th. And what I do is I collect the closing disclosure because there's a lot of line items to read on that. I collect the appraisal report and I look at tax property records. And that's just to start a cost seg analysis, is getting a correct starting point, and you need those 3 documents. After that, then it's mostly collecting data and getting an engineer involved to break down how your house is essentially built. Oh, well, this is an awesome graphic, and I totally forgot to put it up here. But this is how a cost seg works, right? You see these different buckets, right? 2.9 million, breaking it between building, land, with a cost segregation, 2.9 million. Now we're assigning it to different pieces. So this is the example here. I'll kind of run through this quickly, but it's a great illustration of the benefit of a cost segregation analysis. So you buy a property for 900,000. We're going to assign $700,000 to the building, 200 to the land. So what we're playing with here is $700,000. Okay, because we can't depreciate land. We don't really care about that too much. We just have to track it. With no cost segregation analysis, you will take the residential rental property, depreciate over 27 and a half years. You will get roughly 22 grand of depreciation every year. Okay. With the cost segregation analysis on that 700 grand, we're going to break it out into these. We're going to allocate 20% to 5-year property, 10% to 15-year property, and then the remaining 70% is going to the building. Again, we can take bonus depreciation on 5 and 15-year property. So in this example, the key details, if you really want to go through the math, you can, but you can get $225,000 of depreciation in year 1. So if you're looking to juice that loss in year 1, it's the difference between 22 grand and 225 grand. So I wouldn't necessarily recommend skimping on a cost segregation analysis most of the time because it is a large number, and I personally will never recommend doing a cost segregation unless the benefit outweighs of paying for one, of course, right? It makes no sense to do a cost seg if you're just paying but not getting a benefit out of it. That's an excess.
Sorry, I have one more question. Can you go back one more time, Kevin? So if you do the bonus depreciation, and let's say you sell your house without any profit after 3 years, you basically sell it for the same price. How much do you have to pay back of what you have depreciated? So my question is, do you have to hold it for a certain time period in order to like neutralize, or will you always have to pay it back no matter when you sell your house?
In your scenario, yeah, you would be paying it back. So if you took 225 grand of depreciation, your basis, how we compute the gain or loss on your rental property at that point, we look at what's called the tax basis. And at a very high level, that's essentially the $700,000 here, right? Or plus the 200,000, but we'll just look at the building for ease. 700,000 minus your accumulated depreciation over those 3 years. So for ease of math, let's say you took 250,000 of accumulated depreciation. Your tax basis is now $450,000. And in your example, you sell it for 700. Your gain, the difference in those two numbers, is going to be $250,000 for tax purposes. And right, we're just going to ignore the land here. that gain is going to be taxed at ordinary rates because you got an ordinary deduction here. The IRS is essentially saying depreciation is a tax deferral method. Again, like I said, it's not permanent. So it's a strategy that you kind of have to think through a little bit.
So it's not free money, obviously. So that means in order to accumulate wealth, you're not supposed to sell it once you have done the bonus depreciation.
No, not necessarily, right? You can do some arbitrage here. Like if you know you're in a very high tax year in year one and you need a deep, like you did really well at your job and you had a massive, $500,000 bonus that you weren't expecting. You're like, man, 500,000, that's going to put me on top of my W-2 in the highest tax bracket. I should probably do a cost seg today because that was an anomaly. And even if I think I'm going to sell the property in 3 years and you're not going to be in that high of a tax bracket again, it makes total sense to do it, right? It's just arbitrage. It's timing. Timing is crucial. If you know certain fact patterns in the future, in the past, you can kind of play with this a little bit. And there's 1031 exchanges and stuff like that you can do too to push off.
That, or you just keep it forever and keep adding more time, right?
And at the end of the day, right, it's time value of money. It's a financial metric of I want my refund today so I can go invest in another property to do this again. I want more money today than in 3 or 4 years. I'll deal with that problem down the road. But
if
so
you
that's
convert
how
it in 3 years instead of selling it after 3 years, convert it from a short-term rental into a long-term rental property, do you then have to pay back any of the bonus depreciation you took?
No, the greatest strategy is to buy a rental. Even if you hate short-term rentals, buy a rental property in December, get 2 or 3 stays in December, manage it yourself, hit the 7-day threshold, do a cost segregation. Then in year 2, you hate short-term rentals. You already got the juiced up depreciation in year 1, switch it to long-term.
Oh, that sounds great. Okay, got it.
Yeah.
Thank you.
So again, there's like a bajillion avenues down this that if you work it right, there's a way. Kind of going into that scenario like of planning strategy stacking here, all these things kind of complement each other. So what I just described is this first example, a short-term rental. You're just doing it for a very short period of time. I hate managing short-term rentals. We have one, don't like it, but whatever. I generally, don't let the tax tail wag the dog. You hate short terms, it doesn't work for your life. But if you want to hit this loophole, a very good strategy is hit the STR loophole, which we'll go over next week. In the first year, do a cost segregation analysis, claim your bonus depreciation in year 1. Since you hit the STR loophole, you can now offset your W-2 income with those rental losses. Then in year 2, switch it to a long-term, midterm, whatever. Another planning strategy here is this mostly works for married couples. One spouse works a full time and W-2, the other is a real estate professional and hits what we call the rep status on our last presentation. The year the rep's spouse qualifies for reps, real estate professional status, you perform a cost seg analysis on your property. Now you're offsetting the W-2 earnings from the other spouse because you're able to use those losses against the W-2. Again, kind of what I mentioned, timing is crucial. And, I generally tell people try not to straddle tax years. But if you have to because of renovations or remodels, that's fine. Generally, a rental property won't get reported in a tax year until you have a legitimate third-party stays. And again, crucial word, generally. How the code is written is technically you can do it. I just like to warn my clients, hey, that's a yellow flag if you have zero rental income. Getting a cost segregation analysis should be done for the first year the property is placed into service. It isn't impossible to do later on, but it is much more costly and time consuming to do it. There's I won't get into the details, but there's different avenues and not loopholes, hurdles you have to jump through to get that cost segregation benefit in a later year if you didn't do it year one. Whoopsies. And then know your tax deadlines, right? Like again, we already talked about it, but you don't have to get the cost seg done before the calendar year end. You just have to get it done by the time you file your return.
Looks like you had a question.
Yeah. So do you, I guess two questions. One is how does the IRS enforce or know if something is a short-term rental? And then if we have a short-term mixed with long-term in the same property, how would that work?
Yeah, so let's say you have a duplex, one side's a short term, one side's a long term. That's a great question. Generally speaking, you want to look at the entire structure of the building. However, it's more administrative work, but if you're trying to grab that benefit with the STR loophole and a cost segregation for the half that's a short term, you can. You just have to keep separate books and records for each side of the property, right? And then you have to make your CPA aware of you wanting to do that because then they will have to place, instead of one rental on your tax return, they should be placing two rentals, property ABC unit one, property ABC unit two, and how they do it in their software will dictate if the loss from unit B, which is a short-term rental, will offset the W-2 income, and then unit A won't, if it has a loss, will not offset your W-2 income. The cost segregation study will have to go into service at the same time, but it's just the character of that loss that you're generating from unit A versus unit B that needs to be tracked and properly go to the right places.
Got it. Okay. And then and does this apply? Can this be applied to uh a property overseas, or can it only be in the US?
No, it can be overseas. It's just going to be the foreign stuff. It's the the lives assigned to foreign assets and the tax depreciation methods are different. I would actually have to. I know the lives and the methods is different for foreign property. I would actually have to double check to see if bonus depreciation would apply for foreign placed property. That's a good question.
Yeah, sounds good. Thank you.
Frank, what do you got?
Yeah, I got one for you. I'm assuming yes, but I've considered building like a ADU on my property. Would all of this apply since it's kind of on this lot? But it would, like in Centennial, they did approve ADU, so obviously I'd get permitted for that specifically. Do you know how that if all this would apply?
Yeah, it all apply. I mean, you can go two different methods with it. Build the property from the ground up. Say I spent $100,000 on this property, have an engineer come in, do the cost seg, or if you're really meticulous with tracking everything, as I mentioned, a cost seg is just deconstructing the building, essentially, like summary wise. So if you're like tracking like foundation port, 5 grand, framing, 5 grand, electrical wiring, outlets, blah, 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 five. And if you're like going through the whole thing, you technically could bring that to a CPA and you wouldn't have to pay for a cost seg because you're already doing that from day one, is tracking each component of the structure.
Mm. Okay, great. Thanks.
Yeah.
I've got a question as well. How does any of this change? So not a long-term rental or a short-term rental, but rather a house hack where, you're renting out your rooms to roommates and living in it as your primary residence.
Nothing changes. So the whole cost seg bonus depreciation in general, there's one change. It doesn't really matter. It's not material, but 99% of the stuff is the exact same across the board. It is really the characteristic of that loss. So in our first presentation last week, Generally speaking, rental real estate losses, right? That's what we're trying to generate here. Losses are passive in nature. Your W-2 income, or if you're self-employed, your business income is active. Again, generally speaking, passive and active losses in income do not cross with one another. They stay in their separate lanes. So, where let's say you have a long-term rental or even a midterm rental and you don't qualify for the short-term rental loophole, I personally recommend still doing a cost seg. You're still going to get the benefit. You're just not, if you have a huge loss, generally speaking, that loss cannot offset your W-2 income. It doesn't mean that loss will go away. It'll carry forward year over year until you use it to offset more rental income until you until you sell the property. So it's not like it's poof, it's gone, right? And as we discussed, you want to and you should be doing a cost seg the first year the building goes into service. It's just really like, again, time value of money, cost benefit analysis. You may not get that huge benefit in year one to offset your W-2 if it's a long term or midterm rental, but you don't lose the benefit entirely. You might just, you know, huge cash flow year 2, 3, and 4, but you have this cachet of losses generated from the cost seg to push those down every year on your tax return.
Okay. But that will not eat into your W-2, as you said before.
No, and again, the fact pattern, there's like a bunch of different exceptions, loopholes, that kind of stuff. You want to make sure you don't hit any of those. And if you don't, then yeah, generally speaking, those losses do not offset your W-2 income.
And when would losses from real estate offset W-2 income?
Short-term rental loophole, real estate professional status, active participation exemption, and that's kind of like a couple of fact patterns you have to hit all of those.
Okay.
And we'll
Three
talk about
separate
that.
ones.
Yeah, and we'll talk more about that next week, right, Kevin?
Yeah, the short-term rental one we'll hit on. We'll hammer it next week.
Gotcha. And as for the real estate professional, is that only for service based, or could that also be like an analyst in an investment group?
No, that would not work. It's generally 11 industries and analysts, or like if you have a W-2 job that's not from your own S corp, even if it's like, let's say you have a W-2 and you work for a construction or land development business, right? That's one of the 11 industries that qualifies. You still have to be at least a 5% owner for those hours to count towards real estate professional status. There's like a couple of benchmarks you have to hit to even qualify for real estate professional. So like the easiest one is you're a full-time realtor. You have to be full-time in one of these industries.
Gotcha. Got to go down to DC and lobby for that. I think I'm a real estate professional, right, Eric?
Yeah.
That's right.
Not yet. Not yet.
Yeah, I mean, this is my QR code. If anyone wants to check out my website, my email at the top, shoot me an email. Happy to help with anything. And our next presentation is going to be next Monday, same time, except we're going to hit home the short-term rental tax hack, or short-term rental loophole in air quotes here. I'll kind of go over like the history of it and how to hit that, because if you're not a real estate professional and you make over 150 grand in W-2 income, this is generally the only way you can use rental properties to immediately offset your W-2. But cool. I will try and
Sorry,
figure out.
how can we book a with you an email, Kevin, or
Oh yeah. Shoot me an email. That works.
sounds good.
Yep.
Yeah,
Thanks,
just have session one
Thanks.
recorded.
Yeah, I think Eric has a recording of that. Yeah.
Yeah, I'll send it over to you.
Thanks, Eric.
Yep.
Cool. Everyone have a good night. Thanks for attending, and hopefully I see you on Monday.
Thanks,
Kevin.
everyone. Appreciate it.
Yeah.
Have a good night.
Yeah.
Bye.